They are panicking. I'm your host, Steve Van Meter, and thanks for joining me today. In our lead story today, the government is now worried the economy can't withstand the next blow, and I want to show you why you should be worried too, because if this one expert's prediction is even close to being right, it would be outright chaos. Now, if you're wondering what we're doing in Gandhinagar, India, well, hang tight. We'll show you why. Now, you received from Bloomberg, Yellen wary on regional lenders amid solid big bank results. So here's something interesting. Normally you don't hear from policymakers that there's any trouble in the system, and yet once again, kind of Janet Yellen comes out and gives us a little tell that she's concerned. Now, if there's any concern on your side, she's the Treasury Secretary, and we know that after the banking crisis, that a bunch of regulators have shown up in these small and regional banks and are going through everything. It wouldn't be hard for the Treasury Secretary to pick up her phone and make some calls, because I imagine there's someone who would pick it up on the other end and at least give her an idea of what's going on. So the mere fact that she's even indicating that there's potential stress still in the system is a major concern. Treasury Secretary Janet Yellen says she's encouraged by the quarterly earnings of the large banks in the U.S. so far, but is waiting to see how the regional lenders, which occupied the center of a near crisis in March, have fared. The ones that I've seen have been pretty solid, she said, and suggests the banking industry, certainly the bigger banks that have been announced, seem to be benefiting in some ways from higher interest margins. And of course they should be benefiting, because when you see failure in an industry and you see banks failing and money massively migrating, all of a sudden these big banks, they don't have to pay competitive interest rates. There's no need to say, hey, do you want to put your money back over there where you're afraid of losing it, or do you want to put it here? And oh, by the way, we're not going to pay that much because we don't have to. And if you don't like it, take it somewhere else where you're perhaps not going to have the confidence that that bank's going to be in business. Well, you can be assured that we're likely going to be here tomorrow. And of course, that's all helping these big banks' bottom line by allowing their net interest margin to go up. But now let's look at what else Janet had to say here, because this is the real telling. We'll see what happens with the regional banks, she said, which could be more adversely affected. Now, that's an obvious statement here. We know the small regional banks cannot compete in terms of net interest margin. There's just no way. They already had a problem trying to keep deposits on the book. So what she's suggesting is, as these earnings come out, that maybe there's still going to be some adverse effects in the banks, which could lead to further deposit flight. Now, the question is, do we already know the answer before these banks even report? Well, the answer is we do. As here we see from Zero Hedge, emergency bank bailout facility usage remains at record highs as Fed's QT accelerates. So one thing we don't want to hear at this point is that facilities or emergency facilities are still being used. What we want to hear is them being paid down. So think about this. Maybe you lose your job, there's a financial emergency, and you go and borrow some money from somebody or one of those payday loans, and you know the interest rate is not favorable, but you need cash now. So you go to someone and you get the money you need to take care of the emergency. Now, as things get better, what should happen with that loan? It should steadily get paid down and perhaps even quickly paid off, just to say, hey, look, I got through the emergency, I'm okay now, or maybe I still have a problem, but I could go more to a traditional lender and get more favorable long-term terms at a better interest rate that I can manage. So the fact that we're still seeing a usage of the Fed's program is an issue. The fact that we're seeing an increased usage is a major problem that suggests that Janet Yellen already knows what's coming in these small and mid-sized bank earnings. Here we can see quantitative tightening re-accelerated last week. The Fed selling $21.4 billion in securities. The only reason this matters is because everyone says there's a high correlation between the Fed's balance sheets and interest rates, and we continue to see almost marginal movements at the long bond. It's almost unfazed by what's going on with the Fed. So the idea that the Fed unwinding its balance sheet is going to cause interest rates to go higher is absolutely meaningless. But here's what does have meaning is the usage of the Fed's Bank Term Funding Program facility rose once again last week, up now not much, $622 million, hovering around the record level high of $103 billion. And what that tells us is the problem that these banks had with deposit flight has not fixed itself. It's suggesting that perhaps there's stabilization here, or maybe even there's just a small amount of deposit flight, but we're not seeing deposits come back into small and regional banks, and that's what we need to see happen here in order for this real problem to go away, and in order for their earnings to turn around and real confidence emerge back into these banks. But we're not seeing that, and that's why Janet Yellen here, you give this sign that she's panicking a bit. And what this tells us, if there is another crisis, if we do see a recession at this point, or some sort of other effect, maybe from the commercial real estate market, these banks are in outright no position to survive what will come. And yet the Wall Street Journal, trying to actually put some good news into the situation, reported that big regional banks reported stable deposits. For investors, that counts as great news. Well, not so much, because it's not the big regional banks that matter, it's the smaller ones. Because here we can see KeyCorp, Western Alliance, and Zions posted sharp profit declines, no surprise. But here's the thing everyone's excited about. Their deposits were stable or higher compared with the first quarter after customers yanked their money earlier this year across the industry. Other regional lenders, including Citizens Financial and M&T, also posted higher deposits over the quarter. So what do we already now know? If the larger regional banks are saying, hey, look, our deposits here are fairly stable, maybe even growing a little bit, and yet the Fed's program, their emergency program, is still seeing increased usage, who does it tell us that we're seeing deposit flight from? You've got it, the small and mid-sized regional banks, and they're under a major amount of stress. I think confidence in the system has been restored somewhat. Well, I'm not sure I agree with that. According to the chief executive of Rhode Island-based Citizens, I still think we're in a challenging environment. Well, as long as banks are going to the Fed for money, you bet it's a challenging environment, particularly with the Fed still in play. Banks had to shell out more interest to keep depositors around in the second quarter, and after another rate hike, made investments such as money market funds more lucrative than bank accounts. The rapid rise in interest expenses has eaten into profits, especially at mainstream banks, which typically don't have the big fee-based businesses like wealth management of their larger counterparts. So now we're already getting some idea here that the banks, we're seeing some stabilization here. We're going to get some reports that probably show the small and mid-sized banks lost some deposits here. All right, but they're still in business. And what is the Fed about to do next week? Well, you know what's coming, and it's not good for the banks. Compared with a year earlier, deposits were down at banks of all sizes, but many mid-sized and small banks had to rely more heavily on costly sources to fill in the holes, such as loans from the Federal Home Loan Bank system or deposits that are brokered through a third party. So what we're seeing is we're going to get these reports and say, hey, the deposits are relatively stable, but they cost them a ton of money to keep them, and that's why profits at these banks are going to be down. The only question remains is how much longer can they survive without any sort of shock to the system, and if there is one, well, it's game over for many of them. A key profitability metric known as net interest margin fell broadly at regional banks in the second quarter. No surprise there. It's to measure the difference between what banks charge on loans and what they pay on deposits. It's been a big question overhanging the banks, the regionals in particular. When does the bleeding and net interest margin stop? The question is, it stops when the Fed quits hiking rates and perhaps starts actually cutting rates. But one thing that shouldn't be bleeding is your trading account, because if you had CTA Timer Pro, we got an update on our soybean trade. You know, we've been tracking this on our Sunday show. We'll have a broader update on some of our positions. Here we can see the report said it was max short going into this reversal, and one of the fastest reversal signals you see from many other reports. You check this one compared to the other ones. It said on June 9th, buy at open was the original signal when it actually started short covering. Had you taken that trade, you'd be up over 15%, and you would have built into it. We always recommend you trade with a stop loss in case it reverses. Here you see on June 8th, the report max short, and we had been alerting subscribers. We do that twice a week to say, here's the hot list of things you should be focused on for reversal. And sure enough, there it was on the 9th, the fast computer algorithms. Remember, we do an overlay of the computer algorithms on a historical basis to find out when they're at in a nice short position to take a look for a long reversal. There you can see it. It's short covered from that 100% short to 15% short, signaling this was a time to take a position. There's a 30-day money back guarantee. It's only $30 a month. One trade could pay the whole year's subscription. Try it out. You'll be amazed. But one thing people are seemingly amazed about is the number of regional banks that are dimming their profits for the forecast for the year, as many have started to hoard more cash. This is not a good thing you want to see happen, rather than using it to make new loans as they brace for potential new regulations. And now, is it just about regulations, or is it fear of further deposit flight? Well, if you know the Fed's going to hike next week, which we'll talk about in a moment, one thing you should be afraid of is that the Fed's going to raise rates, money markets rates are going to go higher, and you've already gone out of your way to try to raise your rates. You're slashing your profitability, and here comes the Fed again. I don't think it has much to do with regulations as it does with survival. The economy is also expected to slow, no surprise there, which could cause more Americans to fall behind on loans. Of course, we know in June, Americans said they had the first trouble making payments on things to begin with, as loan demand has already started to slow as household budgets are pinched by higher interest rates and cooler but still high inflation. So here we could see some admittance that the economy is going to slow, there's going to be some issues here, and that consumers are going to need loans but be unable to get them. Of course, we already know this means inflation is indeed coming down, but it's not fast enough for what's coming in the economy. And sure enough, as we have noted, here we have loans and leases and bank credit against the consumer price index, both on a year-on-year change. And what we can see as loan volume, you see loans and leases and bank credit slow down their growth and eventually will head negative at some point, most likely in the cycle. That means fewer loans are being originated, less new money is being created. And if you have less money, that leads to less consumer demand because they can't access credit to buy things. And of course, when they can't buy stuff, that means prices come down. That's why you see these two things in this nice relationship together, that when bank credit comes plummeting down, well, so too does inflation. And as we know, the banks don't want to lend. And it's not over just on that side, because here we could see the PNC chief executive. He thinks commercial real estate, especially in the office spaces, will have trouble even in the case of a soft landing for the economy. Now, we know this is going to happen because I think we're reserved for what happens in that book. Maybe PNC is, but broadly the industry is absolutely not. We'll need those reserves because we do think there's going to be problems in the office space. You think, well, when you see buildings transacting at 60% of their last sale price, you bet there's going to be problems, because who's holding all these loans? Small, mid-size, large regional banks. So the large banks are saying we're okay for now. We'll find out the small and mid-sized banks, well, probably aren't as good shape as we want. But you bring commercial real estate into this equation, and you can see there's going to be a lot of chaos and bank failures coming. But before we see any of that, well, we've got the Fed. As Fed seen hiking final time in a 22-year peak in Economist survey, as Fed Chair Jerome Powell and his colleagues have signaled plans to hike rates further following a pause in June that was intended to slow the pace of increases as they approach a level believed to be restricted enough to return inflation to their 2% target. Of course, we know that projections in June showed 2 more hikes, and we keep saying there is a point where they should be done. It's pretty obvious that they should be at this meeting, but the problem is, after the last meeting, all these Fed speakers came out and said, I thought about voting for one more. I think we could do another one. And boy, if we didn't do one at this meeting, I was all on the next meeting. Well, they boxed themselves into having to raise rates this meeting. The question now is, what is left of this banking system that the Fed hasn't broken yet? Well, I think we might find out in the months following this next hike. While Powell said he sees a narrow path for a soft landing, the Fed staff has predicted a U.S. recession, according to minutes of the recent FOMC meeting. Among the economists surveyed, most of those not expecting a formal downturn are looking for continued expansion and don't see growth dropping to zero or turning negative. Well, I got news. I think it is turning negative. But one person who doesn't, of course, we shouldn't be surprised. And the reason we're in India is because this is where the G20 meeting was, as well as our Treasury Secretary. Yellen says China's slowdown risks spillovers, but not to the U.S. No recession here, she says. Many countries do depend on strong Chinese growth to promote growth in their own economies, particularly countries in Asia, and slow growth in China can have some negative spillovers for the United States. But she said in the U.S., growth has slowed a bit, but our labor market continues to be quite strong. That is, until it's not. I don't expect a recession, she said. The economy is on a good path to bring inflation down without major weakening in the labor market. Of course, you start looking at the banks, you see another banking catastrophe. You start to see the banks even further restrict on their lending capabilities, as we've pointed out in prior shows. As we see loan growth slow, unemployment in terms of new claims goes up. As for China, the Treasury Secretary highlighted relatively weak consumer spending in the relatively slow economic rebound following the country's post-COVID reopening. But she said here in the U.S., she knows it looks like consumers are more focused on building back their savings buffers. Now, what that means is when people drain down their savings to virtually nothing, then they rebuild it. So the whole thing that now she's pointing out that we keep hearing from bankers, oh no, there's tons of money. Consumers are just piled full of pandemic stimulus money still, eager to spend it. Now we're seeing from Janet Yellen, hear her say, hey, look, I think they're rebuilding their savings. Now, if someone's rebuilding something, what does it mean they're making a trade-off? You got it on the spending side, on the consumption side, and that doesn't bode well in terms of seeing inflation resurge. No, it means inflation's coming down even further. And here you can see the personal savings rate and the consumer price index. Personal savings rate in blue, CPI in red, both on a year-over-year rate of change. And you can note in periods, I marked them in yellow, where consumers start rebuilding their savings, inflation comes down. No surprise, rebuilding savings, inflation comes down. Here you see it in the global financial crisis, savings going up, inflation coming down. And it makes sense because if you're rebuilding your savings, what you see over and over here, well, what you're doing is spending less. And here we can see more evidence that consumers are indeed tapped out. But what is the big risk? What was that one expert's concern? Well, here we're turned to billionaire Sternlicht sees a Category 5 hurricane spurred by the Fed rate hikes. And of course, as we know, it's not about the Fed rate hikes, and specifically, it's about what the bond market thinks about them and that inverted yield curve, and how the inverted yield curve causes banks to tighten lending standards. And when they do that, they originate fewer loans, create less money, and now you're on path for a recession. It doesn't become an if event, it starts to become a when event, and how serious of an event. Financing is now more expensive and harder to come by, he said, as landlords with floating rate loans are facing the prospect of higher debt payments. At the same time, office vacancies are piling up in the remote work era as demand for other property types such as apartment, warehouses, hotels remains strong, but he thinks that changes in a recession. In the meantime, as I pointed out over and over, tight credit conditions are complicating developers' efforts to start projects or refinance existing buildings. Starwood, as he said, for example, reached out to 33 banks for a loan on a small property and received only 2 offers back. But that's not the issue here, is lenders throughout the U.S. face similar challenges, he says, with an estimated $1.4 trillion in commercial real estate debt coming due by the end of next year. So the story isn't going away just when we have a recession, which we'll have likely before the end of next year. It's going to only get worse as we get into the end of next year, unless the Fed is back at zero, and don't be surprised if they are. You can see a second RTC, he said, referring to the Resolution Trust Corp, the government entity charged with liquidating assets at the Savings and Loan Association that failed in the 1980s and early 90s. Why is that, he said? Because you can see 400 or 500 banks that could still fail, and they'll have to sell those properties. It'll be a great opportunity. And now we come back full circle to the beginning of the show when I said there would be outright chaos. Could you imagine right now if 400 or 500 banks in the U.S. fail, what that would do to consumer confidence, what it would do to spending, what it would do to our economy? And you can imagine it would be outright devastating. Is it impossible? No, I actually believe it is probable, but I want you to see that the policymakers, the regulators, and all the people we put in charge of the system can't see any of it coming. And when they do, the only recourse is interest rates back to zero. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.